I think there's enough warning signs right now as we get through July, get into August and September, that seeing a 3 to 5 to 6% pullback is certainly there.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of the week for another weekly market recap featuring my good friend, the melodious portfolio manager, Lance Roberts. Lance, how you doing?
I'm just fine, but not feeling, I'm not doing any melodies today.
It's going to apply to the rant that we have at the end of today's discussion. We're going to talk about songs. I will out you, though, as a not bad guitar player, and maybe one of these days, Lance, we'll have an intro. We'll have a little Thoughtful Money intro with you picking on your guitar here.
Actually, I've been toying around with that for a while because Brent Clanton, who produces my radio show every day, he plays bass, drums. So we've got all the makings for a whole RIA band kind of in play. So, and one of the problems we have with our radio show is that our YouTube, and you know this as well with Google, is you can't use any copyrighted music because Google will shut you off. So we may have to start writing our own intro music.
Where you could write your own, or is where you get to in the rant. It's getting easier and easier to create really decent music that you own the rights to. But we'll leave that as a teaser. I guess one thing I'll say, Lance, is if your RIA band needs somebody to play the cowbell, you just give me a shout.
Always need more cowbell.
Exactly. Bruce Dickinson always needs more cowbell.
Exactly.
All right. Well, look, let's jump right into it, Lance. Markets back at all-time highs, baby, pretty much.
What were yesterday?
Yeah, when I wrote this last night, we were at all-time highs. We're down a smidge so far this morning. Obviously, still could close green. We'll see. So I want to get to the TA, but before I do, I want to read something that you just wrote, Lance. Okay, and this is a couple sentences, so bear with me, folks. Earnings season continues to roll, and the window for the buyback window won't be open until the end of the month. Starting today, markets tend to enter a seasonally weaker period of the year as investors process earnings and volatility begins to tick higher. Market action has already been slack over the past couple of weeks, and it's highly deviated from moving averages. A reversal back to the 200 daily moving average is would be about a 6% decline, a move that would be well within historical norms. Of concern now is the high level of retail investor speculation, making up about 14% of trading volume. That's more than was seen during the meme mania of 2021. It was only 12% back then. Such spikes in speculation typically occurs at a market peak and is a setup for a market correction. We cannot stress enough the importance of taking opportunity to rebalance risk and take profits now. A 6% correction ain't nothing. Yeah. All right. So, the market has got its party hat on. Lance Roberts, who, tells us, look, don't get shaken out. Don't let bearish headlines, make you run for the hills, but is really starting to say now, hey, you've been saying for the past couple of weeks, really good time to lock in gains. But it sounds to me like you're saying, hey, look, this is getting really stretched now, folks.
It is, but this is exactly the same thing we were writing back in February as well, before we had the March-April sell-off.
Right, before the market sold off by 20%, right? That's why I'm bringing it up.
Always kind of get chastised because when I'm on here with you and I'm talking, and I tend to be a bit more bullish than a lot of other of your guests, and so I get a lot of chastising that Lance is he's just a perma bull. He's always bullish. I am not a perma bull by any stretch of the imagination. When it's time to get bearish, trust me, I have plenty of reasons to be bearish. We're just not there yet. But I also get kind of hit up because I talk a lot about, hey, it's time to take some profits, reduce some risk, rebalance your portfolio when you're kind of getting a little bit extended from markets, but the markets can keep going up for a while. So we would say, well, you said take profits and the market kept going up. Well, I didn't say sell everything. I just said rebalance some risk. So, I know we normally do trades later. Let's do trades right now because, this is what we did in our portfolios yesterday. So we own NVIDIA, we own Palantir, we own GE Vernova in our portfolio. Those stocks have had massive gains this year. We've bought and sold GE Vernova numerous times, and it went from 100% of our portfolio, had 100% gain in the portfolio in April. It's now at 150%, right? So it's just gone kind of vertical. So all we did was we did two things actually. So in the target, in the model, and again, we talk about sizing a lot. And this is, I had a long conversation with one of your viewers yesterday. He sent me his whole portfolio. He was like, tell me what I need to trim. And I'm like, I can't do that. I don't know anything about you. I said, but this is why it's important to have an investment policy that includes sizing. So when you're building your portfolio, say, well, this position is supposed to be 2% of my portfolio based on beta volatility, these type of things. How much should it make up of my portfolio? So if something goes wrong, it doesn't completely destroy my portfolio. So, GE Vernova as an example was about 2% of the portfolio. It had grown to over 3 in the portfolio. So we raised the target in the portfolio to 2.5% because we like the company, we like where it's going. So we raised its target weighting and then sold down to that new target weighting. So it's now 2.5% of the portfolio. We did that with NVIDIA. We did that same thing with Palantir. Those stocks have had tremendous runs. We took some gains there. And then we bought we took some of that cash and we actually bought a little bit of BlackRock, which had really, really good earnings this week, got sold off on earnings. So we picked up a little bit of that exposure. And then we added to our Annaly mortgage position, which is a mortgage REIT, has about a 13% yield on it. Because as the Fed starts cutting rates, mortgages will benefit. So that stock's gotten a bit of pressure here recently because of this debate back and forth. Will the Fed cut? Won't they cut? They're eventually going to cut. It's just a function of when. And so we use that opportunity on a bit of a pullback here in Annaly Mortgage to add to that position. So it now makes up about 2% of the portfolio. It's not big, but with a 13% yield, it creates a nice addition to the yield drive of the portfolio. And then in our platinum model, which is our kind of high net worth accounts where we manage, like family office of money, those type of things, where we use options. We actually bought out of the money S&P puts for October, which gets us through kind of earnings season into the seasonally weak period of the market. And then we also wrote calls on Palantir and NVIDIA and those stocks that are in that platinum model as well. We wrote calls on that. So we took the premium from the calls, bought out of the money puts. So we basically had what's called a cashless options trades, and didn't cost our clients any money. But right now, S&P puts are extremely cheap. Nobody wants to buy insurance for their portfolio, which is usually a really good time to buy insurance for your portfolio because, one, it doesn't cost you any money hardly. It's very cheap. And generally, when everybody's very optimistic, markets are kind of in a position where they're set up for some type of a correctional event. And again, doesn't mean a crash, doesn't mean 20%, but a 5 to 6 to 7% correction is completely normal, particularly in August and September. And with markets stretched and deviated, I would kind of expect that. So go into your portfolio, do a little bit of trimming and pruning and working around the edges. Think about adding some hedge exposure to your portfolio. If we're wrong and the market just keeps going up, great. Those stocks that are winning are going to keep winning. The Apples, the Amazons, the NVIDIAs, they're going to keep doing fine if markets keep going up. But if something happens and we do get a pullback, you'll appreciate that you took some gains off the table and now have some cash on the sidelines that you can put to work somewhere else in the markets on a correction.
Okay. And I'm trying to remember when it was months ago, maybe it was around at the turn of the year. But I remember there was a period of time where I was hearing both from you, Lance, and from the New Harbor guys, the same thing. Hey, S&P puts really cheap right now, amongst the cheapest they've been in years and years. So I actually took your guys' counsel and put some in my portfolio, and that actually worked out really well for me. Yeah. And we talk on this channel all the time about risk management and whatnot, and obviously you want to buy insurance when it's cheapest, right? That's where you get your biggest return on it. So I just want to flag for people, it sounds like we're back in one of those areas here. Now, obviously, if you start playing with options, again, for most people, I highly recommend, if you haven't traded them before yourself, get a professional to do it for you for a while until you learn how they work. But right now it sounds like it's a really good time to consider them.
Well, look, hedging your portfolio and however you want to do it, you don't have to buy options. There's nothing magical about
just
options.
Move to cash. I mean, there's simple ways to do it, but yeah.
Exactly. Buy bonds, buy bonds versus hold some cash. You can, if you're a little bit more sophisticated and understand options and how to understand delta and gamma and all that, then do options. You really need to understand realized and implied volatility when you're doing options, because that has a big impact on what return you're going to get out of your options if you do it wrong. So again, to Adam's point, if you really don't understand implied and realized volatility, you should probably find somebody to do your options work for you. But again, it's not required. Just hold some extra, take some profits out of stocks, hold some extra cash. If you simple math, right? Let's just do some simple math. If my portfolio has a beta of 1, which means it's going to do exactly what the S&P does, up and down. So if the market declines 1%, I'm going to be down 1%. If I raise 10, 15, 20% cash in my portfolio, I'm not even recommending you do that much. I need it's early in the morning on a Friday. I haven't had near enough coffee, so I need some easy numbers to work with. But let's just say for easy math purposes, right, that you have 25% cash in your portfolio. So if the market goes down 10%, you'll be down 7.5% simply because you have 25% cash. So it hedges your downside risk just by owning cash. You don't have to get fancy. But just doing something is better than nothing in a lot of cases.
Yeah, absolutely. One thing just on hedging, if you're interested in perhaps learning more about these simple options trades that Lance has talked about, again, as I said, if you don't have experience, you should really have a professional do this for you for a while. But if you just want to learn about the mechanics and how it works, we have a video that we did here on Thoughtful Money about a year ago that explains the basics of these strategies. And that's just at thoughtfulmoney.com/hedging. And it's a free video to watch. So if you want to watch that after this one, feel free to do so. So, okay, Lance, so basically you are, doing what you've been advising, especially over recent weeks, which is to say, hey, look, risk management's really important. Given how stretched things are becoming, this is a time to really lean into it. So you have trimmed back your positions, just doing your normal position sizing, rebalancing, which you talk about all the time. And then you've done some additional risk management this time by using the options trades here. But obviously you're still quite long in the market, right?
Right. Hold on. And it's always very important. I want to make sure everybody understands clarity, because I have a lot of clients that watch this show.
Yeah.
So the options, we have a model, a portfolio model that uses options. So that, what we call our platinum model, that model has options. Our standard 60/40 allocation, which is what a lot of people use and they track and they follow either through SimpleVisor or our clients that own them, that portfolio does not use options. We do bond transactions as well as cash transactions to hedge those portfolios as well. So a little bit different structure. Most people are not comfortable with options, because when you buy an option, for instance, if I hedge the portfolio, this is how most people kind of wind up dealing with options. I buy an option and I pay money for it. So let's say I'm going to hedge the portfolio and I pay $5,000 for this option. I'm going to buy this put for $5,000. The market goes up. The put option goes to 0. I lose all that money. And so a lot of people get really upset. It's like, I just lost $5,000 in my portfolio. Well, no, you bought cheap insurance that you didn't need, because now your portfolio has gone up and it's a wash. A lot of people look at it that way.
Sorry to interrupt, but it should be like why you're happy your house didn't burn down. Like, okay, I wasted my insurance premium because my house didn't burn down, but I'm glad it didn't burn down. Yeah,
exactly. But a lot of people really can't wrap their heads around it. This is why options are you have to be careful when you're dealing with options. There's a lot of nuances to them that weigh on human psychology, and we wind up making a lot of bad decisions. There's going to be a lot of retail traders that are going to lose a tremendous amount of money in this market, I would suggest, with even the next couple of months. But, when in 2022, I wrote several articles about this in 2022. In 2021, we had a very similar setup with 0 days to expiration options were being traded heavily by retail investors. Everybody was just, on Robinhood and on Reddit, talking about how much money they're making. And, in the next few months getting into, and in fact, I'm writing an article for this for next week. But in the next few months in 2022, they lost all of their money. And in a lot of cases lost more than they had invested, because they were on leverage on top of that. So, that's a story that replays itself out over and over and over again in markets. And this isn't new. Adam, you'll remember we had the same thing back in 1999. We had, I've got pictures of magazine covers back in 1999 about how the retail trader was taking advantage of Wall Street, and these dot-com kids were making millions of dollars trading stock, and the vast majority of them lost everything in 2001 and 2. But that's just the story of how this plays out over time. Options are not for the weak of heart.
Yeah. And they're not for
money.
the weekend tourist either. Like, you really need to know how they operate. That's why I'm sort of underscoring, don't try to figure it out on your own. Learn from somebody else first. But I want to connect a couple of dots you just mentioned there. So last week, Lance, you made the comment that you've not seen this level of market speculation since 1999, right? So that the retail investor is really stretching for yield here, which is really it's an impressive comment, Lance, only because we just went through COVID, where we gave people a bunch of money and they had nothing to do but get into the markets, right? And the markets were on fire, right? So if we're at higher levels than that, that's pretty concerning. But also, what's different about 1999, and you and I are old enough to have lived through that era, right? Now the stocks themselves were just crazy, story stocks. I want to say they were leveraged, but they weren't leveraged in the technical way. But they were. It was all about a narrative, right? And when that narrative didn't materialize, a lot of these stocks, like you said, went to zero. But people were mostly buying just straight equities. It's become a lot easier since then to open, a Fidelity account or whatever and get approved for options trading. There's a lot more vehicles there. These leveraged ETFs. I mean, there's just so many different ways to add octane to the speculation now, which I do think makes this market perhaps even more vulnerable to speculation, or the winds of change in speculation, than it was back even during the crazy dot-com era.
Oh, no, absolutely. There's a vast difference between the markets today and the markets back then. It was funny. I was just talking about this on the radio show, I think Tuesday or Wednesday, that SPACs are now making a big comeback. And, we've had a record number of ETFs. We had over 300 ETFs come to markets last year. And the important thing about this is, and we talked about this a lot, you and I talked about this in 2021. And, back in 2021, we saw the rise of the SPAC, and we saw all these companies come out and do SPACs, and the vast majority of them went belly up. But what we said back then, and it applies very much to today, is that Wall Street is a business. And, it always kind of cracks me up. One of my favorite taglines from a brokerage firm is UBS, because it says, UBS, you and us. Like, you're in this together. Like, they're going to work on your financial outcome with you, and we're here to hold your hand, and we're going to make sure you do all the right. No, that is not the way this works. It's UBS is you, and we're going to use you to make our money. But Wall Street is a business. And so when there's a lot of demand for speculative risk, they're going to come to markets. There's a big push right now. We had this conversation. I've written about this before, but we had a big conversation earlier this week. Big push right now to get private equity into the hands of retail investors, either through your 401k or direct induction. Now, the problem with that is that private equity is deemed to be this vehicle that has lower volatility with higher than average market returns. Sounds fantastic. Well, the problem is the low volatility is a function is that it only prices once a quarter at the most. And sometimes they don't price but once or twice a year. So when you don't have a price change from 1 month to the next, there's no volatility. But once you make this public through a vehicle like a 401k plan or an ETF or direct investment capabilities through markets, you've got to have daily market updates, right? So you have to market that vehicle every single day. Well, so now you've completely lost the whole low volatility angle of that, because now it prices with the market. And then the second thing is that when you bring all these deals into the market, you're going to lower the returns, right? Because what makes investments sustainable to create higher rates of return is scarcity. And all of a sudden, if I've got to come to markets and just find every deal I can get and get it to market, that means that you're going to get a lot lower quality deals to market, which will give you much lower rates of return. And unfortunately, the reason that Wall Street is so hard on pushing this right now is because the big high net worth investors are invested in the good deals, and now Wall Street's trying to figure out how to get rid of the second tier deals to the people they care about less, which would be you.
That's what I was going to say, which is, okay, put yourself in the mind of the big investors that are invested in private equity, and you've got the ability to tap the public markets, right? When you look at your portfolio, what are the assets that you're going to say, okay, I'm going to take this out of my private portfolio and sell it to the public? You're going to say, I'm going to take every illiquid dog that I've been stuck with, right? And I get to get this thing off my balance sheet and get paid, hopefully, by some sucker, a nice price for it. Like, you're literally going to be the dumpster, for their junk on their balance sheet.
Exactly. And so it's a terrible idea, but again, everybody's clamoring for it. So Wall Street's pushing for it, and so Wall Street owns the SEC, so the SEC is going to go along with it, and this is going to wind up in your 401k plans. It's going to be horrible for investors at the end of the day, but it'll be great for Wall Street.
But you know what, Lance? Nobody could see it coming. That's all I'm going to say.
Yeah, exactly. We can pull this video up in about 5 years and go, we told you.
Yeah, I mean, we did it with SPACs. We're, I think, in the process of doing it with buy now, pay later, and I think we can add this one to the list too.
Yeah, exactly. Right. But back to the whole conversation here is that we are seeing today the very same things we saw in 2021, very same things we saw in 1999. Look, every time is different, and that also means that every time will work out differently. This doesn't mean the markets are about to crash, but what there is worth paying attention to is that when you do have a lot of greed and speculation in the markets, it tends to lead to poor outcomes at some point in the future. And again, we talked about predictions before, last week, Adam. I can't predict when this is going to happen. All I'm saying is that in last week, I kind of laid out my odds for the next 3 months, 50% that we have a pullback of 5 to 7%. 50% was that this market kind of holds together and kind of gives us some forward returns. There's about a 35% chance that we get a 5 to 7% correction, and about a 15% chance the market just does nothing for 3 months, which is kind of a rarity, but it happens sometimes. And so that's still kind of the playbook right now. But this is why it's worth hedging and taking profits. But that doesn't mean sell everything you get out of the markets, because these momentum-driven, greed-driven rallies, like we saw in 2020 and 2021, can last for quite some time before you actually get to the next event of what causes a pullback. Yeah.
Okay. So just to be super clear, you're raising increasing risks about the level of speculation and correction risk in the market. It's leading you to do some trimming, but you're still staying majority long, and you're not ringing to get out of the water bell yet.
Yeah. And trust me, if we get to that point, where we see that you need to get out of the markets now, like in 2007, I'll tell you, I'll say, hey, we're down to 15% exposure, right? That type.
That's why we do these weekly.
Yeah, exactly. So, I'll tell you, and there'll be plenty of indicators to tell us to do that. But again, I think there's enough warning signs right now as we get through July, get into August and September, that seeing a 3 to 5 to 6% pullback is certainly there. And, again, look, we have this whole, the markets are looking right through tariffs. They're saying, these tariffs aren't a big deal. The recent CPI, PPI reports certainly, are showing that the market's right in their view that these tariffs are not inflationary. But, we have this thing hanging out there on August the 1st that all of a sudden a bunch of countries get slapped with a, 35% tariff or whatever. That could certainly kind of create that, kind of pullback in the markets as markets go, well, if it is going to stick, I've got to reevaluate earnings growth and lower my expectations, because expectations for third and fourth quarter for earnings are still very elevated.
So this is probably too extreme of a comment, but I think the sentiment is similar, which is, you've heard of that expression, a bubble in search of a pin. What I kind of hear you saying, Lance, is we have a overvalued market here, or highly speculated market that's kind of just looking for the reason to correct by 6%.
Yeah. That's absolutely correct.
Yeah. Okay. Yeah. Can you do me a favor? Can you pull up the TA? I just want to see where we are, just in terms of, deviations from daily moving averages and stuff like that. And I think you mentioned here that a reversal back to the 200 DMA is certainly something historically that could happen here. I want to see how far away that is from where we are right now.
So
Pretty far.
yeah, it's about 6% from where we are right now. As of where the market's trading right now, we're about 6% away from the 200-day moving average, which is this black line down here.
Okay, and sorry, just help me. What number is that? Ish?
I'm sorry. The blue line is the 200-day moving average, and that's currently. No, I'm sorry. Rephrase all that. The red line is the 50-day moving average. That's currently sitting at 60.28. The 100-day is sitting at 57.98, and the black line is the 200-day, and it's sitting right about 5,900 ish.
5,900. Okay.
Yeah,
All right.
so
I mean, yeah, 6%, but again, 5,900 was people were pretty happy to be there a few months ago. But yeah.
yeah. But look how strong money flows have been. That's that shaded area in the background. So money flows have been exceptionally strong. If we start to see that turn lower, we saw those money flows start to turn lower back in really kind of May, and that's where the market just kind of struggled and went sideways here for about a month or so, about a month and a half through May and June. Those kind of money flows pulled back, but the market just kind of hung in there and just kind of traveled sideways. And then we've had this new kind of speculative bubble here just recently, where a lot of money flows have just come flying back into the markets, and have pushed markets back here to new all-time highs. This blue line. So like I said, I wrote last week in the newsletter, which you can get a copy of it at my Substack at Lance Roberts, on X at Lance Roberts, or on our website at realinvestmentadvice.com. But in last week's bull bear report, I laid out that parameter of possibilities and probabilities going through the summer. So the blue line is kind of the bullish probability, that 50% case. This market just kind of grinds higher here for the next month or so. The 35% case is what pulls us back to the 200-day moving average, which gets us back down to these kind of previous support levels. The 200-day moving average will rise up to that. And then this kind of very faint red line as the market just goes sideways. That's that 15% probability. So this is just kind of laying out that pathway. And right now, as you can see, the market's just kind of trying to grind up that blue line. Really since I wrote that article last week, we're just kind of tracking that blue line right now. So we'll see if that continues to play out. My gut says that's probably not going to be the case, because we are on a momentum sell signal there at the top. We triggered that earlier this week. Relative strength is fairly overbought here. It is correcting. So we have a bit of what's called a negative divergence. We have a rising stock market and weakening relative strength. So that also is kind of another one of those indicators that, from a technical basis, suggests that the market's kind of running out of gas, so to speak.
Got it. And key question here, and I think I know part of the answer. What has been driving the money flows, this latest resurgence in money flows since over the month of July?
Institutions trying to play catch up with retail investors.
Okay, and how much is buybacks?
Big chunk of that.
Okay, and
which is also now ending.
That's where I'm going with this.
As of the beginning of this week, we're in full blackout mode for the next, kind of 2 weeks.
Okay, so whatever percentage of those money flows buybacks are, and I'm just throwing out a number, let's say it's 40%, is going to go away as those blackout windows come in.
That's correct.
Yeah. Okay.
That's also another reason kind of for weakness.
Exactly. When you say running out of fuel, to me, that's an important part of the fuel that's running out.
Yeah, absolutely.
Yeah. Okay. I want to ask you just if there's anything you want to say about a piece that you wrote recently about the difference between relative returns and absolute returns.
Yeah, well, I mean, that's something I think that's worth a read for your viewers is, and again, you go to realinvestmentadvice.com and get that Substack at Lance Roberts. You can get that piece. I wrote it on Monday. One of the things, and again, so we focus in our shop on what's called absolute return. So what's the difference between absolute and relative? Relative is what Wall Street preaches to you. They want you to just buy and hold an index, and you get relative performance to the index. So if the S&P goes up 1, you go up 1 theoretically. So that's relative performance. It also means that on a relative basis, if the market goes down 20%, you're going to go down 20% with the market, but that's okay because now you can put more money into the market, which is always interesting because nobody ever tells you to sell. So you have no money to put in at lower prices because you never sold at the highs to raise some capital to buy at the lows. Mm-hmm. So absolute returns, and I laid out, a couple of charts in this as well. But absolute returns are, don't worry about what the market does. Focus on what's important. So if I need a 5 or 6% rate of return in my portfolio, I build a portfolio to generate 5 or 6% rates of return most every year. And as long as I'm achieving that absolute return basis, then I'm doing okay, because the goal, so, our basic premise in how we manage money is what we call the 80-20 rule. And we want to capture 80% of the upside, but no more than 20% of the downside. So good example, in March and April, the market was down 20. Our worst drawdown in that period, we were down about 5.5%. So we were within our tolerance of that 20-80 type model. And so our portfolio got back into positive territory and actually was hitting new all-time highs before the market was. And that's because of that. So I don't have, and what the important lesson of this is that over time, which is we're long-term investors, our goal is to grow our wealth to meet retirement benchmarks at some point. I don't have to beat the markets every year as long as I can avoid big drawdowns in my portfolio. So the whole purpose of this article is, if you look at an absolute return portfolio that underperforms every up year, but outperforms in down years, you actually wind up outperforming the index over time. You wind up making more money with much less volatility. And that's the goal of investing, because if I can have a lower volatility portfolio, my emotions don't lead me to making mistakes and buying high and selling low, which is what happens to the majority of investors. So I think it's a really good article to read, just to try to, rethink how you approach your portfolio. And instead of chasing the market, start thinking about what your goals are and start building a portfolio, managing it to meet those goals, rather than some random index, which has nothing to do with your portfolio. Because next week, not this coming Monday, but next Monday, I'm actually writing an article on portfolio benchmarking and all the flaws that are in portfolio benchmarking, like substitution effect, replacement effect, buyback effect, that has all the impact on an index, but you don't get the benefit of. And I've got tables explaining all that. So that's kind of a supplementary piece that goes to absolute relative returns. And so we'll have those two pieces. And I'm eventually going to convert all this into an ebook. We just came out with our real investment guide. That'll be available, I think, next week. It's got to the publisher. It's all done.
Cool.
So the next one will be this absolute return type structure book that explains all this in more detail.
Fantastic. All right. So when you get the portfolio piece written, Lance, we'll have you walk through that in depth here on whatever week that comes out, that week's market recap. Yep. So no, I agree. This is an important piece, and I wanted to take a moment to talk about it, because I've been finding myself kind of repeating this message a lot recently, Lance, which is it really, as an investor, it really all starts with, what are my goals? What am I trying to hit by when? And then you do the reverse backwards looking math to say, okay, then what kind of absolute return do I need to be getting to get from here to there? And for a lot of people, especially, a lot of people who watch this video who have some wealth already, generally, or a lot of times, it's you need less than the market return, which means that you can take less risk, right? And get there with less hand wringing, less surprises, less stress. You can sleep better at night and still hit your goals by the time you need to hit them. And, a lot of people, for one reason or other, they just haven't, been taught this, or they're just caught up in what everybody else does, which is generally this, like, well, I got to try to beat the market every year, right? Mm-hmm. One, there's no guarantee you're going to, but let me just give you an example where beating the market still doesn't help versus an absolute return, right? If you've got a safe, steady path to follow with an absolute return that gives you, say, 4% a year, whatever, right? But you're taking, I want to beat the market approach. There are years where the market's going to be down, maybe down 12%. You might be down only 10%. Hooray, you beat the market, but you're still down much more than the steady Eddie approach of the absolute return. And I'm not saying the absolute return doesn't, it's not a guarantee. There's volatility in there as well. There just is a lot less. And so if you can hit your goals with a higher probability and less risk, like, why wouldn't you do it? So one of the things I've really been encouraging people to do, Lance, is to, if they haven't done it or if they haven't done it for a while, to revisit what their financial goals are. And I know that, there's a lot of professionals like you and your team out there that can sit down with people, and you've got tools and processes and all sorts of things that can really help draw out of people, okay, what does the future look like for you if you end up having the kind of future you want? Well, you want to retire by this stage, you want to buy this vacation home here, you want to pay for this kid's education, all that stuff. Like, do all that math and then figure out what you need to get from here to there. And I think way too few people do that, or they do it way too infrequently. Like you say, if it's been a year since your last one, it's out of date, right? So everybody should make that a priority this summer, in my opinion.
But and what you just said is so critically important, because I was listening to this girl on TikTok, and you got to be really careful about where you get your financial advice from. But she's claiming that, 10 years ago, she was 40 grand in debt. Now she's worth $10 million. And so she's doling out this financial advice. And it's the typical run of the mill financial advice. You can tell it's not somebody that actually has financial acumen, because they're just kind of regurgitating what comes off of television. She's like, oh, if you're just, did you realize if you just put $75 into an account every week and you get 10% returns every year, in 10 years, you can never put money in it again. And by the time you retire, it'll be $1 million. Does nobody remember we had a 20% drawdown in 2022, right? You didn't get a 10% return this year. And here's the important thing. Markets do not compound returns. There's all these people running around saying, oh, compound interest is the greatest thing about the financial markets. Markets don't compound returns, because if you have 1 year, and we can do simple math, right? 10% a year the first year, 10% the second year, I've compounded 10% 2 years in a row, right? Third year, I get 10%. I've compounded that again. Third year, I just lose 10%. My compounding rate of return is now 5%. I've cut it in half. It now takes me in year 5 to get back to compounding my 10%. I need a 30% return in year 5 to get back to a 10% annualized return. So down years absolutely destroy the compounding effect of money over time. And this is why people never reach their goals on this idea that if I just invest in the benchmark, I'll be great, because markets don't compound. And so this is that. But the reason that Wall Street tells you this, oh, just buy an index, it's fine, because they're making money on it. They're charging you fees for you to hold an asset. They collect that fee. They don't care what happens to you, but you do, and you care about your money. So this whole idea of chasing markets, trying to beat a market, great. You beat the market by 1% last year. That's awesome. In a year where the market's down 22, you're down 21. Great. You beat the market. You've still lost 20% of your money. Plus, you're not getting the 10% rate of return you were supposed to get. So technically, you're down 32% in that year that you've now got to make up in the next year, where you also have to create that 32% return plus another 10% to get back on track. The math is absolutely vicious.
So totally agree. And we'll move on from this in just 1 second,
Yeah.
but the math becomes much more vicious the older you are.
Absolutely.
Right?
Oh,
When you're young, you can recover from this stuff, maybe over the long term, the long-term averages play out for you. They should mathematically. But when you're 50, 60, 70, and you get a curveball in a down year, and you lose a lot more than you were hoping to, as Lance said, you just don't have the time to recover from it.
Well, John Penn John Penn's one of our top advisors in our firm. He's an awesome guy, extremely
great
smart
guy. Yeah.
And super knowledgeable. And so he and I have been starting this podcast on Tuesdays called Two Dads on Money. And we're just addressing a lot of these millennial and Gen X, kind of Gen Z issues. And we were talking very specifically about that on Tuesday, which is the one thing that you have that you cannot replace. If I lose money in the market, I can go earn some more money and put it back in the market, right? I can replace that. But the one thing I can't replace, the most valuable commodity that we have, is time. I can't make more of it. I can't get more of it. And if I wind up losing a tremendous amount of money and spending 5 years or 10 years getting back to even, if you don't think that happens, go back to 2000. It took people 13 years to get back to even in the markets. So over a decade of their time horizon of saving and investing for retirement was wiped out through those two bear markets during that period. So it can happen. And that's 10 years that those people never get back to trying to get to their goals. And so a lot of those people who were ready to retire in 2000, they never retired because of what happened in the markets.
All right. So just to put a pin on this,
yeah.
Folks, your mission, should you choose to accept it this summer, is to update your financial goals, your financial plan around them, and to hopefully find the best risk-adjusted way to try to hit your goals by the time you want to hit them.
Yep.
All right, Lance. So I want to switch over into the world of bonds now. So bond yields have been rising again. They're down a little bit today, but they were getting close to 4.5 on the 10-year. I think more interestingly, the 30-year got above 5.04%, which is the highest yield it had been at in 18 years.
Mhm.
Um, and if you think 18 years back, US federal debt was at 9 trillion. So it's tiny now, right? It's over 4 times that today. And of course, that's just federal debt, and not even taking into account private household debt and stuff on top of that. So I get a couple questions for you on this, but just first, anything to say about what's going on in the bond yields right now?
No, no, so back in, I think I can't remember exactly when. Let me take a look at, I can give you a good ballpark because you and I were here on the show and I told you about long duration bonds. Yeah, back at around the end of May, I bought some long duration bonds in the portfolio. Had a very nice rally in those bonds going into early July. I sold that position that I had added to the trading position, took that back off again. And bonds have just gotten very overbought. And so we just it really, if you look at bonds, they're just trading in a sideways range. They're not really going anywhere, not going up, not going down, and they're just trading in a big range because we still have a lot of institutional shorting on bonds. So every time bonds rally, they start shorting the bond again, and they're just making, and it's a way for them to make money in it. So that trade continues. We got a very, very large short position in bonds that continues to kind of keep yields capped. The yields aren't really moving anywhere. We're just kind of trading between 4.5. And really that's where bonds should trade for the most part. We've said this before, is that bonds are trading about where they should right now because we just got the CPI report last week. We're at 2.4%. You're expecting GDP growth to come in at about 2.3%. Add those two together, that's 4.7. So you're about where you should be on Treasury yields relative to economic growth and inflation. So, but as we get further out into this year, and particularly when the Fed starts cutting rates, then we'll see those longer term yields start to come down.
Okay. So that's your we'll call it your professional opinion right now. There are people making the argument, you definitely don't have to agree with it. This is why there's a market. There are people that are thinking that we may see the opposite, which if the Fed starts cutting the bond, vigilantes, will say, hey, look, we've got concerns that
Can we stop right there? There are no such things as bond vigilantes. Those don't exist.
So for those that have been reading about them since the 1980s, give you a reason for why.
And if you will just please take 5 minutes of your day and go look at 10-year Treasury yields from 2008 to 2020 when the Fed held rates at zero. Tell me what inflation and interest rates did on long bonds when the Fed cut rates. And in fact, do me a bigger favor. Please go pull a chart of Fed funds rates versus 10-year Treasury yields and tell me what happens when the Fed cuts rates and Treasury yields.
So, I mean, I hear the argument you're making. I guess
I'm not making an argument. It's the facts. It's the data. That's it.
Okay. So
everything else, all these other things that you're throwing out there, that's just assumptions and emotions.
Okay.
There is no such thing as a bond vigilante.
These aren't necessarily mine. I'm just channeling what I'm reading and hearing from others.
Well, no, but you have the similar opinion. It's okay. It's fine.
No, I don't necessarily have a similar opinion.
I just want you to go look at data. Look, my job is simple. I look at data. That's all I do. I don't have an opinion one way or the other. If, here's when we take a look at different asset classes, there's time to own them. There's times not to own them. Right. So, but there's certain things that drive certain asset classes over long term, and the data supports that. And again, you go back and look at the history of the data only tells you one story. And you can try to narrate it, you can try to change it. But at the end of the day, the only thing that moves interest rates is economic growth and inflation. That's it.
Okay, so let me get back to this again. So to your point, during the GFC period of 2021, we didn't see any bond vigilante activity. But again, inflation was super muted. And yes, the Fed was out there cutting and QEing and everything.
Stop right there. Yeah. Why was inflation muted? Because you had an economic collapse. There was no activity in the economy. People could not afford anything because they just lost their house. They lost their job. So there was no inflation.
Sorry. Yeah, really early on there, but not 20. 2012 through 2021.
You had no growth. We were growing at 2%. So
Yeah.
coming out of the financial crisis, people were still repairing themselves. The average economy was not great from 2012 through 2019. You didn't start getting a boom in economic activity till we started sending checks to households and telling people they didn't have to pay their debt anymore.
Yeah, no. So, okay.
We are living hand to mouth for the most part. 80% of people couldn't pay a $500 bill.
Well, so I mean, look, it wasn't it wasn't a prolonged recession for the American economy from 2012 to 2021. Now, I'm the first one to say that we've increasingly had a K-shaped economy that went on steroids after all the stimulus efforts of COVID. But I think one of the issues too, as we've talked a lot about, is, generally monetary activities have resulted in asset price inflation, but not so much cost of living inflation. Although, I think we can all kind of agree that the CPI doesn't necessarily track everybody's lived experience in cost of living.
But nobody cares about that. The only thing the markets care about is CPI and PPI, right? So it doesn't matter what your personal view on CPI is, whether you think the price of eggs is too high or not. The only thing the market cares about is what the government reports, right? Yep. Everybody talks about, hey, all the employment data is fudged. Yeah, it is. Market doesn't care.
Right. So let me just throw these points out and then let you respond to them. And again, this is not Adam Taggart's position. This is just, I'm saying, some on the other side of this argument are saying is, okay, so what's different now? Okay, now you have a Fed that's going to be, cutting interest rates at some point, like you said, maybe aggressively, if Trump eventually puts in somebody who's just sort of a yes man there at the Fed. And then we have, some folks are still worried about, stubborn inflation and a pickup of an inflation from here. And there's some argument to be made that could happen from here. Then there's the tariffs. Right.
And there's you got to back up. You can't just throw that out and then just walk away from it.
I'm going to let you respond to all this. Let me add one more thing and then you can shoot all these.
But I'm just saying is they're worried about these things, but you're not providing the detail why. Like, okay, so what's going to cause inflation to spike back up? What's their reasoning? What's their reasoning for why inflation is going to go back up? You just can't come out and say, oh, I'm worried about inflation going back up. Okay, why is it going to go back up?
Yeah, so there are others out there that are worried about inflation beginning to pick back up. I just did an interview yesterday, and I'm trying to remember the exact points why. Okay. And I don't think it's general base effects, but I to be honest, I'm not prepared to have this argument in terms of what the inflationistas think is going to be driving it. But you can look at recent CPI. It has nudging higher, right? And some people think that it might go back up.
That's year-over-year base effects. That's all.
Yeah. Some people will say tariffs, right? No tariff, but other people will say too that also just
tariff impact PPI or CPI.
Yeah, I know from okay. I know your argument on it. I'm just saying.
No, it's not my argument. It's the fact. You just had PPI that was 0 on headline and core on CPI just came in cheaper than expected. There is no tariff inflation. So
look, I'm right there to say we haven't seen much of it yet, and I'm more on your team here, which is to say, look, I think it's probably going to be less than, but we still don't know because we don't know exactly what the final tariffs are going to be.
Right, that's why Powell's not cutting rates because he's so worried about inflation showing up. But here's an important thing about tariffs and inflation. What drives the economy today more than anything else? Services. In the 1970s, see, everybody's going back to the 1970s. Go, well, if we have tariffs, we have an inflation, 70-style inflation. Well, in the 1970s, you had 80% of the economy was manufacturing. So that required a huge amount of imported commodities and manufacturing. And that producers are the ones that pay tariffs, not consumers. Producers pass on the tariff to the consumer, maybe, if they can afford to. But today, 80% of the economy is services, 20% is manufacturing. In CPI, over 40% of CPI is housing. And you took any real-time indicator of what's going on with rents or housing prices, where are those headed, right? Because certainly those aren't headed up. So in and of itself, if you had an impact of tariffs in CPI, the swamp effect from housing alone is going to null that out. But where is inflation show? We did have tariff inflation in the last CPI report. It was in appliances, right? But how often are you going out to buy a new washer and dryer?
Right. And look, we've talked about this. I
Right.
think
So,
I think if tariffs have an issue, it's going to be a one-time effect too. Like I
well,
don't think
not
it's
only
an
that, it's
ongoing
just
thing.
right. I'm just saying is that the reason it's not going to show up in CPI is that the big drivers of CPI don't pay, and that services primarily in housing, they don't pay tariffs. That's all domestic. 75% of revenue generated by US companies is generated domestically, which means that revenue's not getting impacted by tariffs because we're primarily a service business, right? Uber doesn't pay tariffs, Lyft doesn't pay tariffs, Tesla doesn't pay tariffs. So that's why all this fear about tariffs, and that's why Powell's wrong, he should be cutting rates now, is because tariffs don't have that impact on the economy. And then, everything else you're going to bring up is all deflationary. So go ahead.
Okay. I actually want to dig into you on tariffs again for a second on a question I asked the other day that hasn't aired yet, and I'd love to get your answer on it.
Sure.
And by the way, I am just serving up these arguments for the other side.
I'm not arguing with you.
Well, it feels like it.
Okay. I'm not. You're just lighting a fire, so you're going to get burned. That's
no. I really, you're kind of doing what I was hoping you were going to do. You're just being mean about it, but it just other people are saying, what's your position?
Adam, I'm sorry. I did not mean to hurt your feelings.
Now, hey, look, buddy, dude, you're my ride or die. This is nothing.
Absolutely.
But the last point on this too is just fiscal spending. Right.
Yeah.
And that's something that is different from coming out of the global financial crisis, which was just the monetary side. Now we actually have the fiscal spigots that are still going to stay on. Right. And so, that totality of things that I just listed, and many of which you've poked holes in already, but, some people think would cause bond investors to say, hey, you know what, if inflation isn't done and we've got these, you're not your 2% target and we've got these concerns out here and you're starting to cut, I want higher yields as a result.
Yeah, no, that's not the way the bond market works, though. Again, at the end of the day, what the bond market looks at, so you have to remember that. So the problem with all the arguments that you're getting from these people is they don't understand how the bond market really works. At the end of the day, if I'm going to loan you money, Adam, I don't care about what the debt is. That means nothing, right? What I'm worried about is I'm going to loan you money for 10 years or 30 years. I need money. I need a return on that investment that exceeds my opportunity cost of investing in something else in the economy, right? So that's why economic growth is important. I also need to outpace the rate of inflation. So my return has to be above the rate of inflation. So that's why inflation is important. So, but that's how I calculate what that yield needs to be. Now, once we get into the secondary market, yeah, we've got buyers and traders that are moving the prices around, but the bond itself, the yield itself, is driven by economic growth and inflation. And over the long term, that's what's going to mature in the markets. Now, in the short term, from a day to a week to a month to a year, that's just driven by trading. And so markets are going to go up and down. And one thing you'll notice is that every time we go into an auction, which we just had, which is why yields came down, is that bond traders start going in, they heavily short the 10-year treasury going into the 10-year bond auction, so that they can buy the bond cheaper.
They can get a better price. Why is that not price manipulation?
It is price manipulation, but it's just legal.
Why?
Why
like
can I?
The biggest market in the world. How could that be legal? Why should it be legal?
But why? This is the whole market itself, right? This is stocks. It's everything else. I mean, you have major institutions that go in and they do what's called subpennying on stocks. They put in bids on stocks and then pull the bid before it gets executed. And they do that about 1 million times over the course of a second or two. They drive the price of the stock down, come in and buy the stock, and then run. And then, of course, then they start selling it out to their customers.
But isn't that illegal?
Prices. Yeah, it happens all the time. It's high.
No, but isn't that illegal if they get caught for it?
No.
Really?
It's high frequency trading. It's the way the market. It's all these algorithms and things that we have going on in the markets now. This is what Wall Street does.
I thought that was illegal, like spoofing, well, whatever. But
I mean, no, I'm just saying, but the same thing Citadel does, right? So like you trade on Robinhood, everybody thinks, oh, I'm getting free trades on Robinhood. No, you're not. Because what they do is they pull up all the trades, they sell them to Citadel.
Right, and they front run you and all this crap.
Exactly, and that's all legal. But that's all the manipulation that goes on. So it happens in the bond market, it happens in the stock market, it happens everywhere.
All right, I mean, I think the answer here is it's
But long term, look,
it probably is illegal, but it's sort of one of these things where they're like,
it's
look,
very
we need
gray.
these guys to buy our bonds. We need to rely on this market. So if they're going to skim a bit, we're going to let them because it keeps the system going, which is one of the things we hate about Wall Street is there's all these different ways in which the players there get all these kind of free ways to make money and they get a hall pass for it because we kind of are dependent upon the whole
Yeah,
system.
but no, absolutely, it's a legal mafia. Look, the bank. I've called the banks forever, the major banks. So the major banks are the only ones that play in this market, right? You have to be what's called a primary dealer in order to
Right.
buy
And this is
bonds
what,
from
like
auction.
17? I mean, there's not many, right?
20.
20. Okay.
So these primary dealers are the ones that go into market. This is JP Morgan, it's Wells Fargo, it's Goldman Sachs, it's these guys. And so I've called them for years. They're a legal mafia because they control the Fed. They control the bond market. They basically control all this. So they can certainly handle and kind of quote unquote manipulate the market to their advantage so that they make money. And this is why, look, if you just look at what happened with bank earnings this week, where did JP Morgan make all their money? Right? Where did Wells Fargo make all their money? It was on their trading desk. It
Yeah.
wasn't through
The
lending
prop trading.
activities, right?
Yeah.
So,
Yeah. And
understand the game.
we've ranted about this in the past, but
Yeah.
there have been years where they've had a year of perfect trading days, which is like statistically so impossible, but everybody looks at it with a blind eye and lets these guys get away with it. But that's a different rant for a different day. I'm going to mention one more thing about the other side of the bond argument, and please let me finish before you jump down my throat because I know what you're going to say in general, but I'm taking this somewhere. They'll also say, nobody wants treasuries anymore, right? Foreigners are giving up on buying treasuries, and that's another reason why yields are going to go higher from here. And I think one of your answers is going to be no, they're not, because if you look at the data, they're still buying this stuff.
Yeah.
And secondly, you just wrote a piece. What was it called? China's economic demise and its impact on the U.S. And you think that this could actually, some of the troubles that China's going through right now, will actually cause capital to find greater safe haven in U.S. Treasuries.
Yeah, absolutely. Kyle Bass was interviewed, and this was articles written kind of based on his interview. But he made one very important statement. He says, "Capital doesn't walk; it runs." And when the ongoing problems that China has, as well as Japan has huge demographic problems that have yet to foster maturity.
Right. Again, a terrible timing metric, but from a trend perspective, you can bet your life on it, practically.
Yeah, absolutely. When those come to fruition, and this is why I've heard people say, "Oh, BRICS are going to take over the world," type thing. No, they're not. For a whole variety of reasons. But at the end of the day, and really that article on China is more about the dollar. But that also has to do, as money flows go back into the dollars, they go into dollars through treasury.
As they go back into treasuries, they go into dollars. Yes,
exactly. So yeah, no, and again, that's not a function that happens today. That's something that plays out over time. But just when you look at the record number of ghost cities that China has, and the housing problems they have, and the other economic issues they have, and of course their one child one policy is now caught up with them. The outlook for China is not great, and that's going to push capital back into the U.S. probably sooner rather than later. But between that and the debt, which is very deflationary, that really impedes for ultimately lower yields. And the one thing also too, don't forget, is that every other country right now, there's a chart in that article, which I just posted on Substack today as well. You take a look at UK, Eurozone, Japan, they're all cutting rates. We're the only country not cutting rates yet. And so one beneficial factor for bonds is the fact that our yield is now higher than other government bonds, and we have more security through both, national, our military, as well as rule of law and others. Eventually, at some point, that yield spread becomes very attractive for foreign owners of treasuries, and you start getting money flows back into the U.S. Treasury to capture a higher yield. And then the benefit of that is they push money back into the Treasury bond to get a higher yield. That brings up the prices of bonds, and the value of the dollar begins to climb, which they get a double benefit of the currency exchange rate between the dollar rising versus their currency, and better bond, higher bond prices and yield. So they really get a triple benefit for buying treasuries, and that's just a function of time before that happens.
Yeah, and trying to think of a good analogy for this, but I like to talk about with elections, right? Where my personal opinion is that unless somebody's doing well financially, unless you're feeling pretty flush, you generally vote your pocketbook, right? If you're under financial distress or duress in your life, you're basically pulling that lever for the guy who's going to make or woman who's going to make your life better financially. If you're feeling more flush, then you can afford, to vote on these higher order effects. Oh, well, the person has this opinion on the environment or this opinion on, whatever. And that's going to sway my vote. But I think in general, you don't get to those higher level decisions if you're not doing well financially. And I think similarly that's true with countries, right, and investors and capital flows, which is you might say, you know what, we don't really love what the U.S. is doing right now. We think they're kind of being a trade bully, whatever, and therefore we're not going to buy as much treasuries right now in the short term. Once the yield starts getting pretty attractive, you start saying, you know what, I don't really like them, but I'm getting paid more. I'm going to start putting money there. And then if you get some sort of scare, it's sort of like there's no atheists in foxholes, right? If we start having some sort of, global, seismic event in markets, capital is still highly likely to rush to the safety of U.S. Treasuries, just because at that point you're like, screw it, I don't care about anything else except just making it through what might be coming, right? Do you feel similar, Lance?
Yeah, absolutely. And at the end of the day, the U.S. Treasury is still the go-to function for safety and yield, liquidity. It's the currency is the biggest, has the largest amount of depth in terms of any currency. You've got the rule of law, you've got the military to back it up, you've got the assets of the U.S. behind that. So, it's just, and so ultimately at the end of the day, this is why nearly 80% of all transactions still occur in U.S. dollars. So, it's, people try to find reasons like, oh, look, the percentage of reserves have gone down in terms of the US dollar. Well, yeah, that's for a lot of reasons. China's a lot bigger than it was, 10 years, 15 years ago. India is a lot bigger than it was 10, 15 years ago. So, yeah, so that's going to, that just, and we didn't have a euro 15 years ago. So now that we have a Eurozone and the euro currency, that's certainly taken away from some of the reserves that are normally stored in US dollars. But that's still 53% of global reserves of US dollars, but transactions, that's where it matters. Where are people transacting? That's still nearly 80%.
Got it. So for just the daily lubrication of markets, it's still essential. Okay. Exactly. And folks, I don't want to give the impression too that I don't think that the tailwind that gold has against it, or sorry, the tailwind, that gold has benefiting it right now, of central banks, beginning to prefer gold over treasuries, and that's probably too strong of a term, but they're
no, that's actually a right term.
Okay.
Because look, so I mean, no, I think that's a beautiful statement, because gold has been going up in price, right? So if the dollar is declining and I have to store gold, and I do have to have gold as a central bank, right? So so I can store reserves in three manners. I can store it directly in US dollars, I can store it in treasury bonds, or I can store it in gold, because gold trades in dollars everywhere in the world. You can't buy gold in rubies, right? So you buy gold in dollars. So if bonds are falling in price, even though they have a yield on them, and gold is going up, and I've got a choice as a place to store my reserves, where am I going to store my reserves? I'm going to buy gold, because gold's going up in price. Yeah. It has nothing to do with anything else. It's just that asset's going up in price. The dollar's declining, so I can offset the decline in the dollar by buying gold, because gold is going up in price. And gold is very easy manipulated in the markets, because there's not a huge trading volume on gold. So banks are notorious about manipulating gold prices, been doing it for years.
Right.
So I can offset I've got to have reserves, right? As a central bank, or whoever I am, a hedge fund, whatever, I've got to have my dollar reserves. So I've got a choice of where I put it. So yeah, gold has been participating because it's been the offset for declining bond prices. So those are my two kind of go-tos for storing reserves. I can offset the currency risk by buying gold right now, because gold's going up, dollar's going down. So I offset that currency risk. At some point, when the dollar rallies, then I'm going to sell my gold. I'm going to buy the dollar, because now I get a better benefit between my dollar purchases versus my currency, because now I'm getting a bigger return. So I buy treasury bonds, which now take that liquidity out of gold and move it into treasury. So gold will eventually become a liquidity source for a transaction when the dollar starts to rally.
Okay, got it. And so all I was trying to say is I'm not
But
trying
no,
to take
that's a
anything away.
really important statement, though. That's why I
Okay,
interrupted.
yeah, and I'm glad that you explained that for folks, and it also tells people, hey, look, don't expect the gold's rally to just continue unabated, because there are going to be periods of fluctuation where capital is going to seek treasuries more than gold. All I want to say is I think the long-term tailwinds that I've talked a lot about with a lot of experts around gold, I think those are still very much in place.
Yep.
I'm just saying the demise of the U.S. Treasury is probably much overstated right now, and I would be cautious about having just sort of a, hey, look, no one's buying this thing anymore, and it's going to become toilet paper.
Well, and also too, this isn't the first time we've heard these narratives. We've heard these narratives for the last 40 years. Back in the 80s, we were supposed to have a demise of the US dollar and the demise of the treasuries back in the 80s, and that didn't happen. So again, these narratives come and go, and that's why it's always important not to really pay attention to the narratives. At the end of the day, all these narratives, take them, throw them out the window, because at the end of the day, all it matters is there are people with money, and a lot of money, that they have to invest, and they're going to invest in the assets that can make them money. And if an asset is growing and making money, they're going to invest in that asset, which is going to continue to push that asset price up higher, to the point to where they say, maybe I should take some money out of that and move it somewhere else. And then you get reversions in that. And that's why, if you ever look at Adam, have you ever seen those periodic tables of returns
Yes.
things? So it shows like different asset classes.
Yeah.
If you ever look at a periodic table of returns, and if you just go Google periodic table of returns on Google, you'll get all these quilts. But just notice this one thing: at the top of the return list, whatever's at the top of that return list never stays there for more than 1 or 2 years. And then in the next year or two, it's either in the middle of the pack or at the bottom of the pack. And whatever was at the bottom is now at the top. Because why? Was there some big narrative change? Did something happen? No, it's just a function that when things get really, really extended overbought, investors go, you know what? I can buy this over here that's really beaten up and cheap, value stocks, whatever they are, and money will rotate there, drive those asset prices up, and whatever was the winner becomes the liquidity source to buy whatever the new winner is. And this is why chasing last year's returns always work out bad for investors.
Right. You're putting reversion of the mean against you. It's one of the dumber decisions around. Yeah, exactly. Yeah, this is just an application of money goes where it's best treated. And when you've had a fantastic ride and the returns of the ride start petering out, you get to diminishing returns, capital's going to move on.
Yeah.
Yeah.
I will say though, gold, actually real quick, because I know
Yeah.
I know you do like gold, and your viewers like gold. Gold is, we talked about this, a couple of weeks ago. Gold's been consolidating really nicely here for the last 3 months. There's a decent little I don't know how much you're going to get out of it. Maybe you get a couple $100 out of it, but there's actually a decent little trade setting up on gold right now.
On the long side, you're saying?
On the long side, yeah, buying gold alongside. It's sitting right on moving averages. It is flirting with an uptrend support that goes back to late last year. So that's the only thing I'm kind of watching pretty closely here. But on a momentum basis, getting pretty oversold here. And again, you've got a kind of a big double top that's getting built in gold right now, which is a little bit worrisome unless it can break above that. But again, you kind of buy, say GLD right here. It's trading right now around 308-ish. But you had a nice little trade up to 315, 320 probably.
Oh, well, you heard it here, folks. Lance Roberts doesn't hate gold.
I never hate gold.
I know you get guff for it in the comments, which is why.
Yeah. I don't know why. I don't know why, because we have a portfolio called the all weather model that has a huge chunk of gold.
I know that you own gold every time I talk to you. I know. It's crazy.
I don't understand why I get gubbing. I just sit there and say, all I say is like, gold's really overbought. Like I did back in May. I said, hey, gold's really overbought. Might want to take some money off of it. I got all kinds of grief for that, and then it corrected. So
yeah, it's funny what people get known for. You were talking about Kyle Bass, who's a very smart guy. I've actually met Kyle, really fascinating thinker. And he's done some amazing things investing wise. In fact, he's probably one of the leading natural resource investors now in America. He's buying large swaths of natural land like wetlands and things like that, and has found a way to basically create a business model in preserving these resources. It's really cool. But all everybody remembers about him is he's the guy who bought a whole bunch of nickels, right?
I think, and I may be wrong, but I think he has a whole lot of guns too. But
Well, he's a Texan. That's just
yeah,
that just goes with the territory, right?
yeah, exactly.
Um, but anyways, yeah, I mean, such a simplistic trade for a guy who's done so many sophisticated things with his career.
Yep.
All right, so I got a couple questions, the last questions for you, Lance, on the sort of bond yields side of things, and then we'll get to the wrap up. Let me just ask this one quick question before I forget, though, about tariffs. So you and I have, I think, talked a fair. You've talked a lot about how tariffs are generally not inflationary in the way in which most of the folks writing headlines seem to be afraid that they are. And you've shown a lot in Trump's first administration about how the tariffs then didn't really have any inflationary impact. Critics of tariffs will say they're a tax, right? So it's a tax on the American consumer that nobody voted for, right?
Right.
And I mean, I kind of get the logic, right? But here's my thought, or here's my question for you, which is, okay, if we slap tariff X on country Y, and that tariff gets passed 100% onto the American consumer, and the American consumer buys those same products at the higher rate, then
Right.
yes, that's a pure new tax, right?
Yep.
But along the way, that tariff, the impact of that tariff might get eaten by some of the people in the chain, right? And some would argue, okay, but if it's eaten by the importer and the importer is a U.S. company, that impacts their profit margin. So America is still paying that tax, right? My question is twofold. One, we may not get impacted by that tariff because Americans might shift behavior, right? So for example, let's take the BMW. Let's say the BMW gets hit with a big tariff, but consumers now realize that that tariff doesn't apply to American cars, and in fact, the most recent legislation now makes auto loan interest on cars manufactured in America tax deductible. So I might not buy that BMW, I might buy a Chevy, right? The American
You suck anyway, so
pardon me?
it's a BMW suck anyway.
Ah, you're right. Said like a true Texan. But in that case, it's kind of a net boom for America, where the consumer gets an affordable car, probably more affordable than what they had before. They don't have to pay any price increases. They actually get to deduct their auto taxes. And America, the country, gets the tariff revenue.
That's right.
Right? So so on the other side, if a tariff is being passed through by, from country Y to us as well, the manufacturer, the producer in country Y might say to their, importer, hey, look, I understand that if we push the whole tariff onto you, you're going to sell less of these products. I don't want that to happen. So how about we share it, right? I'm going to reduce my wholesale price to you by a certain amount to offset some of this tariff, so that the price hit isn't so big that my sales suffer too much, right? Yeah. So in that case, actually part of the tariff is being paid by an offshore party, not an American party. So my point here is tariffs might not be as damaging as we think, and we do get revenues from them as well that come in, right?
Right. Yeah. No. So there was so CNBC ran this headline. So when and don't quote me exactly on the headline because I'm going to paraphrase a bit, but you'll get the general gist of this. But see, before Liberation Day and all this was probably back in when Trump first started talking about tariffs. CNBC read this whole headline that tariffs don't create revenue; it just causes a tax on consumers. That was kind of the basic assumption. They just ran a headline this past week, which is absolutely hysterical, because it says tariffs create the first budget surplus since like 2017. And so all of a sudden, wait, you said we didn't get revenue from tariffs, but we just did because we just ran a budget surplus for the first time in like 8 years.
Right. Now, just to be clear, they would say, well, we took it from one pocket, we put it in one pocket and took it from another. But you're saying, like me, no, it's more nuanced than that.
It is more nuanced. But to you make a great point, though, about the partnership effect of what's going on with tariffs. So a couple of things that, like I showed you that sign when I was in the UK where they sell liquor and they want to sell liquor to U.S. citizens because that's part of their business. But if I can buy Jack Daniels in the US cheaper than their liquor, why am I going to buy their whiskey when I can buy Jack Daniels whiskey? So they're saying, hey, we'll pay the tariff, right? Buy our whiskey, we'll pay the tariff, and we'll give you 10% discount, because they want to do it. So they're eating the whole tariff on that front. And we're seeing that with a lot of companies. The other thing that's going on is that companies are going, okay, I need to buy this product from X country, but if I can buy that X product through this country, I pay a lower tariff. So they're shifting the delivery of the tariff to a lower tariff country to bring a lower tariff product into the US. And then the company here says, okay, well, I can, eat some of that tariff and, not raise my prices, et cetera. And then to your last point, we are seeing consumers make shifts. We are definitely seeing consumers go, either I'm not going to purchase that right now, right? I'm going to wait to purchase that new washing machine. I'll buy a different washing machine, one that's made in the US, or car, whatever.
Right. Or non-tariff nation, but yeah.
Or non-tariff nation, or I just won't buy it at all. And those decisions are getting made. And again, this is why, I don't know if you saw the University of Michigan data that just came out this morning.
I did. Sentiment's improving still, yeah.
But not only that, the inflation expectations completely plunged. So all this fear of inflation, the end user, the consumer isn't seeing it. So now all these fears of, everybody said there was going to be this big tariff inflation, but I didn't see it. So that fear is coming down rather sharply. And what's interesting about University of Michigan is that's mostly Democrats that they sample in that bias. So it's interesting to see that even that side of the political bias that's embedded into the University of Michigan sentiment is actually starting to reverse now as well.
And as you know, they break it out. So I mean, you can see the huge delta that there still is, but it's not as bad as it was, and it is coming down, where it was really the Democratic respondents who were saying, I'm super freaked out about inflation.
Yeah, exactly. But what I'm saying is that the reality is they're even starting to realize that, everything I was told about tariffs isn't coming true. So now you're starting to see that reversal, which is good. That's a good thing, right? We want to see that.
Oh, no, nobody wants to see
tariffs,
price injuries from tariffs or anything, right? Yeah, exactly. And it is interesting. That is kind of maybe a little bit of a control for something we've talked a lot about, which is, you always say, don't trade by the headlines. The headlines are, always going to lead you in the wrong direction because they're either wrong or they don't tell you the whole story, or sometimes there's an agenda behind them. And, what's kind of nice about that the difference in survey respondents by political affiliation is it's probably highly correlated with different news sources. And so those parties are probably hearing very different news sources, which then leads them to have different expectations.
That's right. No, it's absolutely right. And that's why, for instance, I build a lot of composite indexes to try to strip some of that out. So for instance, I take the University of Michigan Consumer Sentiment Index because I know that that's got a political bias to it. And then I build a composite and I weight that index with the conference board, which does not measure political bias in their questionnaire. They don't care what your political affiliation is, so they don't measure that. So I blend that with the conference board sentiment index, along with Trueflation and some others, to get a more real-time gauge of sentiment, inflation, and those type of things. So it helps kind of strip out some of that bias that gets embedded into survey. It's kind of the same thing we do with political polls, right? If you take a look at the Rasmussen poll or the NBC poll, you'll get these big deviations. Real Politics does a good job of just blending them all together. It says, here's the average of all these. So you get a little bit better indication that way, because you kind of remove some of the bias. And that's an important process for investors to work through, is to, make sure you're not feeding your confirmation bias. And all this stuff that we're talking about today, Adam, is a great example of this, very emotional stuff. Make sure you're not feeding your emotional bias, and listening to one guy or one. Don't listen to me. Don't listen to just one other person. Listen to a lot of different people. Read both arguments on everything. I spend a lot of my day reading people's arguments and then breaking it down back to the facts. So is that argument supported by facts? And that was my statement earlier. That's what I do all day. And that's what you need to do to fight that confirmation bias, is to really get down into the data and figure out, is their argument supported by the actual facts?
Yeah, and we've sort of mentioned a lot of that in the past, so I totally agree. The one thing I'd add to that is, if you find yourself getting emotionally charged, what's really interesting, I talk about the field of behavioral economics, right? And
Mhm.
there's this thing called the backfire effect, where if you come at somebody with data that is contradictory to their position,
Mhm.
in most cases, it'll make people dig deeper into
Yes.
their bias rather than say, oh, this data is good, it's new, I'm going to change my behavior, right? And it's because evolutionarily we've evolved to not change our beliefs lightly, because these are the things that, in a lot of cases, our lives depended on, right? I
Right.
see a tiger, I should run, right? That type of stuff, right?
They're so cute.
Yeah. So if you're listening to somebody, Lance, me, somebody else, who's saying something and you start getting like emotionally charged, like, no, that guy's wrong, right? It's a sign that the backfire effect is getting triggered in you. And so what you should try to do is say, okay, what specific belief of mine is in opposition to what this guy's saying that's getting me so riled up? And once you can identify that belief, then you can say, okay, great. Let me look at the latest data. Does my belief still hold water? Right. And if it does, great. Then you can say, yeah, that guy's wrong. Right. But if you're like, wow, wait a minute, I'm digging into a belief here, but the more I look at it and try to look at it objectively, wow, this belief might not actually be relevant or relevant anymore. Maybe it was in the past, but maybe
Mhm.
it's not now. Right. So you can use that emotional response as a really good tool to make sure that you're always revisiting your key beliefs that are affecting your decision making, because that's what our decisions are a result or an after effect of our beliefs.
Yeah.
So it's a really good way to just make sure that your beliefs are always, still current and still serving you, right? So, don't just use it as an emotion to just go blind and with rage, but use it as a way to say, hey, that's telling me something really interesting. There's something important here, and just make sure that you're spending the time to make sure, okay, is it still important, or am I
Well,
fighting an old battle that doesn't apply anymore? Yeah.
well, this is why I take so much grief over when I say something about gold, like, hey, gold's really overbought, you should sell it. Well, the reason that people get all riled up about that is because they want gold to keep going higher. They're making money in it and they want to make more money
Right.
in it, right?
Or,
And so
or,
it's
or they have a belief that fiat currency is dying and it's dying, it should die
sure.
tomorrow. And yeah,
Yeah. But again, most of our, most of the most of our fight is generally because we have dollars invested, if Nvidia, Google, whatever. I've got dollars invested in that. And so I want people to tell me it's going to go up, not that it's going to go down,
right.
right? Because I don't want to lose money. And so most of the time that we're fighting these arguments is because I don't want to hear you tell me that I'm about to lose money in gold because I've made a lot of money in gold and it's going up. So I want it to keep going up. And that's all
Right.
of us,
Or,
right?
or
That's
it's
that's
30% of my
everybody.
position and I don't want to feel vulnerable. Yeah.
Exactly. So that's where, really, to your point, that backfire effect is where, okay, this guy just said gold's really over. I'm not saying gold's overbought. I just told you there was probably a
Yep.
good trade up set up for gold. So I'm just using gold as an example, but it could be anything. It could be Palantir, could be GEV, could be Oklo, whatever. Like, for instance, we talked about Oklo a couple of weeks ago, that Oklo was really, really overbought, was due for correction, had a beautiful correction, and had a nice rally since. So, but the thing is that just, when you hear that and you start to Adam's point, when you start fighting that based on some investment you've got, that's probably a good time to go look at your investment and go, why am I fighting that? If the stock does correct, or if gold corrects, or if this corrects, or if that happens, what's wrong with taking a little bit of money off the table? But the reason we're fighting it is because inherently we think we have to sell the entire position. And that's not the case at all. This is why we talk about trimming, pruning, those type of things,
Hedging. Yep.
hedging, because somehow along the way we have this belief that we have to buy everything and then sell everything all at the same time. And that's just not the way investing actually works. But that's in our inherent. But, oh, this guy says that gold's going to go down, I need to go sell all my gold. No, that's not what that means at all. It just means maybe go think about taking some profits and then holding some dry powder until you get a good trading opportunity set up like you maybe have right now, and you go from there.
All right. Totally agree. You mentioned building these composites to
Mm-hmm.
try to blend out the noise and try to get to a true signal,
Mm-hmm.
which totally makes sense and understand why it's been done for a long time. What's really interesting now is we've got another way of doing it, which is letting people put their money where their opinions are. So I'm talking about like the poly markets of the
Yeah.
world, and those are surprisingly predictive.
Yeah.
Yeah, it
Yeah.
really has been so interesting. When that first came on, I was a little skeptical, right? Just it feels kind of like online gambling, right?
Yeah.
Um, but you got to remember that our whole field of statistics came out of gambling.
Yeah.
It was so people could try to understand the probabilities of chance to see if they could win at a game. And so there actually is an awful lot of sophisticated math sometimes behind these things. And it is really interesting that with a profit motive in there, certain things it tends to be superior, at least it seems in certain areas on
Yeah.
predictions.
Yeah, it's interesting. Earlier this week, or actually last weekend, the poly market was predicting that Powell was going to get ousted out of office. And it was a pretty high prediction. Um, so it'll be interesting. There's a lot of this whole issue with Trump and Powell going on right now. Very reminiscent of 2018, by the way.
Yeah. By
So
the way,
let's
that
just
was
see how
my
that
next
works out.
bullet here on my list.
Okay.
So let's go into it.
Okay.
I guess my question for you is one, do you think this is something that's actually likely to happen? Because to me, it almost kind of feels like, trying to get another player ejected, in the last minute of the
Mhm.
game. It's like, the game's almost out. Right? The clock's almost run out. Like this could turn into a big kerfuffle for not a lot of gain time-wise,
Yeah.
but maybe not. I don't know. What do you think?
Well, so look, this is very reminiscent of, like I said, just very reminiscent of 2018. You go back, Powell was hiking rates. Trump wanted lower rates. He was talking about firing Powell. But first of all, Trump can't fire Powell without cause. He's got to have cause from some sort. So they
Yeah.
tried to come up with this whole issue on the renovation of the Ronald Reagan building, and that it was $750 million over budget. He was mismanaging it. Well, the Fed posted on their website, here's all the statements y'all made that are all wrong.
Yeah.
This is what's actually happening. So, so there's no cause there to do it. But outside of that, I think it's a bad idea. Um, the reality is that the Fed is not independent,
Right.
right?
But this would, sorry to interrupt, but I'm going to include this in your answer. This would just destroy the idea of Fed independence, right?
Right. Well, and
If
look, the
Trump,
Fed's not independent. They are politically influenced. And more importantly, they're influenced by the major banks that are their member banks, right? So the Fed works for the major banks and they do get influenced by the government. So they're just, to say they're politically independent is really a fallacy, but we at least want but here's the thing is there's
we
at
want the
least an
appearance of it.
appearance, right?
Yeah.
There's an appearance of Fed independence. And I think that's important for markets. And I do think that if the Fed, and again, I don't know, but I do think that if Powell figures out a way, sorry, if Trump figures out a way to fire Powell, I think that could really, spark a reaction by the markets. We keep talking about this 5-6% correction in September, October, August, September. I mean, you need a catalyst for that, something that the market's not expecting. It's not tariffs, it's not Israel, Iran, it's not any of that. It'll be something like this. And I'm not saying this is going to be the case.
Well, it can't be
But
this because it's now potentially priced in, at least some probability.
yeah, yeah. And so, but if Trump could figure out a way to get rid of Powell and put Warshin or Hassett, who pick your predecessor, Bessent, I think the market I think reacts negatively to that, and then if they do, then immediately if they cut rates on top of that, I think the markets instead of reacting positively, that might respond negatively simply because of the kind of that intervention that led. It's like, okay, this is being pushed by an administration, and so markets react negatively to that. At least initially, we'll see what happens later on.
Well,
But I don't. But look, I think the odds of that are very low. I think Powell's going to serve out his term. I think that probably sometime in March. If I was Trump, again, I'm not, but if I was Trump, I would probably appoint Scott Bessent to be Fed Reserve. I think he'd be much better as a Fed Reserve chairman than over at Treasury, and then appoint somebody to take over as Treasury Secretary.
okay. I might have a slightly different opinion of Bessent's best use, but that's what
That's
makes
fine. I mean, that's
yeah. No, but my point, my bigger point here is if this were to happen, to your point, I think it would destroy the sham of Fed independence, and I think to a certain extent,
it's a very thin veil.
To a certain extent, I think the Fed, it's not entirely dependent on the administration because it's a banking cartel, right?
Yeah.
And if anything, it's really, primary allegiance is to Wall Street. It says to the banks, not. And so I think if Trump were to say, look, you know what, the president can just reach in and rip out that guy and install whoever he wants in his place, I don't think anybody would listen to the Fed anymore. They would just listen to the president. They would just say, where are rates going to go? Well, the guy who can,
Yeah.
eject the Fed chair anytime he wants, right?
Yeah, and that's why I think it's problematic. And again, at the end of the day, Trump has said he's not going to fire Powell. I think that that's the right decision. I'm sure somebody leaned into his ear and said that you don't
Yeah,
want to do
dude, we do not want this. Yeah, and I'm agreeing with that advice. I just don't think it's
that.
Not,
I don't
that I
think
love the Fed. I'd love to not even really have a Fed.
yeah.
To have a market-based solution for a lot of this thing. I mean, I think a lender of last resort, we can have that debate.
Yeah.
But I'm no Fed lover. But I don't think that
Yeah.
replacing a sitting Fed chair for anything other than obvious criminal activity is the right thing to do. Yeah.
And again, I think that's the way it works out. I think this is a lot. This again, this reminds me a lot of 2018. At the end of the day, we didn't fire Powell. He did cut rates because look, and I think Trump's right. I think every other central bank in the world is cutting rates, and we should be cutting rates, and we're not. The Fed would be better.
Sorry, can you explain that just for folks? Because there are folks who would say, hey, wait a minute, like inflation's pretty contained and the economy is not overheating and we're not in a crisis. So why bring rates down?
So there's a couple of reasons why I think the Fed should cut in this next meeting, really, as we get into at the end of this month. I think the Fed should cut 25 basis points. If you take a look at the data, the economic data, it's clearly slowing. We had retail sales out this past week, and it was up like 0.6. Everybody's like, "Oh, it's great, it's up."
Right.
Well, we revised down last month even more than expected. And if you take a look at retail sales over the course, we're talking nominal right now, nominal retail sales. Take a look at nominal retail sales over the course of the last 2 years, they're flat.
Flat, yep.
And that only happens prior to recessions. And that tells you that the economy is actually much weaker. If you take a look at real retail sales, real retail sales have come up a bit because inflation's come down, but that's running at about 2%, which is right along recessionary territory. So it's really weak, and it tells us that the consumer is really kind of struggling here. Then employment is okay, but it's getting weaker. And we did 147,000 jobs. We're not doing plus 200,000 jobs anymore. That rate of growth in employment is clearly slowing. And so if I'm the Fed, and I wrote an article about this about a week or so ago, talking about the Fed's transitory mistake. The Fed's so focused on cutting rates at this point and fearing that they're going to get an inflation spike, they're still hung up in that whole transitory impact when we had all this money flooding the economy and creating inflation. They're still afraid of that. And so the problem that the Fed's going to get into is that every other central bank in the world is already cutting because the global economy is slowing down. The US economy is slowing down. And if they don't start and if the Fed cuts rates by 25 basis points, markets are fine. Markets will deal with that. Okay, it's like, okay, yeah, they're cutting rates, no big deal. But if something happens in the next 3 months, 4 months, 5 months, 6 months, and all of a sudden the Fed has to start cutting 50 basis points at a whack, the markets are not going to like that. That's where you're going to get a market downturn of 20, 30, 40% because the Fed is now aggressively cutting rates to try to stave off an obvious recession.
Which has been its pattern every time up until now. So should we really expect anything different?
Yeah, exactly. Well, yeah, that's the whole point of the article is that the Fed is always wrong. So
always late and
they're always
wrong,
late and always wrong. So, but yeah, but that's why, if they were doing, if they just approach this from a moderate base and say, look, we're going to cut 25 basis points here. We'll re-examine it in September. Maybe we'll do another one in November if needed. But we'll just do this one. But I think the longer you wait, the more risk you run of having to be forced to cut faster than you wanted. And then the market's not going to like that.
So just asking you to guess, and then we'll start wrapping up. Is Powell not cutting yet because the Fed is genuinely still trying to figure out how inflationary, the August 1st tariffs are going to be? Or is it more, I'm kind of boxed in a corner here optically, and I got to look like I'm independent, and I know I probably should cut, but if I cut, I looks like I'm kowtowing to the president. I don't want to do that.
Yeah, that's what I think it is.
You think it's the latter? Okay. Yeah.
I think there's more of that in the equation. Look, I think some of it is concern about an inflation resurgence. I do think that they're still worried about being called out of the transitory status, again, right? But I think a lot of it is if I cut rates here, it looks like I'm kowtowing to the president.
Got it. Okay.
And then again, that very thin veil of appearance of independence starts to get shattered, right?
Right. Right. Yeah. It's getting pretty threadbare,
Yeah.
that veil these days. Okay. So we already did trades. So we'll go straight to the rant and then we'll wrap up here. I want to talk about a experience I had with AI this week. So for folks who follow me on X, you saw I posted there I feel like I got in front of this trend like a microsecond before the popular media. But I asked Grok to make me a song. I just said, write me a country song about dogs, beer, and women, because that's what country songs are about. I forgot the truck, which somebody reminded me. It turns out Grok can actually create an audio tune, but it can give you lyrics, and then you put them into another app. I used a company called Suno, and I mean, Lance, instantaneously, you get a full song, lyrics, instruments, everything, the whole kit and caboodle, and it sounds not bad. Like, I mean, so this country song that it came out with, if I had walked into a bar and that was playing on the jukebox, I would not bat an eye. I would totally have believed it, right? So real quick, I then asked it to create my older daughter just started a job where she is going to basically be traveling across the US doing events for this company. And so I asked it to write a song about a girl named Merritt, that's my daughter's name, driving a car around the US. And it again, created a song instantaneously. It put her in a Chevy and she drives a Subaru. So I asked it to change it to a Subaru. That's the only tweak I made. Whole process took me about 7 seconds. And I'll play a little bit of that right now here. So folks, so you can hear, again, song's not going to win a Grammy, but it's a pretty legit song. And again, this whole thing was created in just a matter of seconds. So here it is.
Hit the open road in her trusty Subaru, carrying a light load from the beaches of Cali to the New York lights, chasing sunsets and stars through the endless nights. Radio blaring tunes from coast to coast, wind in her hair, she's feeling the most. Oh, Merritt's rolling across the USA, wheels turning fast, she's finding her way from the Rocky
So, as you can hear there, folks, like it sounds like a real person. It sounds like real instruments. It sounds like a real legit song. Lance, we are getting to the point here where it is getting just super easy to create, not just songs, obviously, but, the written word, presentations. You were telling me about how, I mean, again, you guys are making lots of investments in AI at RIA, it sounds like, but you took one of your daily podcast that you did and put it into basically asked AI to put it into a chart deck, right? A PowerPoint deck.
Yeah.
And you said that turned out to be really good too, right?
Yeah, it's fantastic. And it literally took like 5 minutes to do it. It's very interesting because, if you're on TikTok, you'll notice that more and more videos on TikTok, you have to be careful. You gotta kind of actually look at them. But I was watching this video the other day of an older gentleman. He's sitting in a chair, and kind of like a World War II veteran, and talking about how the sacrifices they made, and he was giving life lessons about when life gets tough. That's when you've got to really buckle up and start, moving forward. and it was all AI. And I showed my wife it, and we started talking. It's like, I said, the movie industry is screwed. We pay these actors and actresses hundreds of millions of dollars, for making a movie or whatever. You don't need them anymore. It won't be long before AI can generate whole movies. Then it's kind of coming after music as well. I'm seeing a lot more music being created, just like you just did, with AI. It's scary. I don't know what the impact of this is long term, but there's a lot of industries that are going to be undermined by what AI can do. And it's not, my industry is one of them. This is why we're making huge investments right now. We just hired a chief technology officer in our firm who has a big AI background, and we're going to be making a lot of AI investments into our business, so that when you go to our website, as an example, you can just ask a question and you'll get answers for anything you want. So it's going to change the game face of the entire economy in ways I think is more detrimental than fundamental, potentially.
Well, I think the economy and society, and I don't necessarily want to make this rant fully about those, but the key thing that I want to underscore here is the scope of jobs that it's coming for. So I use the term create, but think of create widely, right? Creating a song, creating a movie,
Artwork.
like you talked about actors, but creating analysis, creating PowerPoints, creating spreadsheets. That's what AI is doing increasingly well. And you got to remember that AI learns at an exponential rate. So as good as it got from last week to today, it's going to get even smarter, faster from there. And I was listening to Elon Musk talk about the latest Grok 4 capabilities. This is the latest version of Grok that got put out there. And actually, one of the things that blew my mind is he was talking about it with some of the coders for Grok, and they were talking about how far Grok had come from Grok 2. Mm-hmm. And they said, yeah, back at the start of 2024, when we were thinking about this, well, by the way, Grok 4 didn't exist, but Grok 2 didn't exist then, right? So we've gone through Grok 2 to 3 to 4 in less than a year and a half, right? It just shows you how fast this is improving. But basically, they gave Grok 4, he said if it takes an SAT, it gets a perfect score every time now. And it's pretty much getting almost perfect scores on graduate level exams. And he said, the thing to know about Grok at this current stage is it's like a PhD in everything. So it's like a human might be able to match Grok for its knowledge in a super specialized area that human is one of the leading thinkers in, but no human can know that much across all disciplines. And that's where it is right now. Yeah. So it's only going to get better from there. In fact, one thing I heard that blew my mind is they're saying they're pretty much running out of human data, of all human created content. They pretty much cataloged it all. And that's what these large language models learn from. So what they're now doing is they're having AI start creating its own data, which is what the future versions will be learning from, which is hard to even wrap your brain around, right?
Which is also scary.
Which is super scary. But the whole point of this, right, is, as we've been talking about, it's the benefit and the threat of AI, right? I mean, it gets super smart, which is great, and we'll learn lots of things from it, but it gets so smart so fast that soon, at some point, it's going to get to a part where it's smart in a way that we can't comprehend. And of course, some people say that's when it becomes like a god to us, and that's when we all become, slaves to our AI overlords, and maybe that does happen. But in the immediate term, what I'm trying to flag for people here is this is coming at us at a speed that I don't think almost any of us can comprehend. And a lot of people will say, yeah, but AI, don't worry too much about job displacement. We went through this with the cotton gin and with all sorts of other technological transitions in time. And yes, we did. The issue, though, is back then we transformed one industry, right? We put everybody who got displaced by new technology X, and there was another technology they could go to. Oh, well, we shut down your farm job because we've got mechanized technology there, but there's this new thing called the assembly line for automobiles, and you can all go get jobs there, right? The problem is we're doing this destructive transformation across all industries all at the same time. There's going to be,
Yep.
in large cases, nowhere to go for a lot of these people. And that's the thing I just want to put on people's radars. I don't want to freak you out, but I just want to say, look, if you're putting your head in the sand against this, this is highly likely going to steamroll you. So
that's why, like when we hired this chief technology officer, I sat down with him. I said, here's your job. I said, you don't have 5 years to get me to where I need to be, because AI is going to be all in our business within the next 2 years. And we're going to see, when you go to talk to a financial advisor, or when you go to get information about the financial markets, it's all going to be AI generated at some point. And so we have to get well ahead of that curve. And so the stuff he's developing very quickly now is amazing. And it's what's even more amazing. And this is where, we told I saw this video by Steve Rowe the other day talking about, we told our kids to go to college to learn to code.
Micro.
That was the future. Micro. Go to, tell our kids to code. Those jobs are gone. I was just playing around this morning with an app, and it programmed an app for me in about 3 minutes, and it worked. And I'm going, this is just crazy. This all these backdrops I have every week with you.
Yep.
Those are all AI created. I just tell ChatGPT, make me an image of this. I'm sorry, this is Midjourney. Make me an image of a bull, with this or whatever, and it creates it. So, I used to actually pay an artist for graphics we would have drawn for our X channel and stuff. I don't do that anymore. And
that's my whole point. Like these songs I'm talking about, if you were going to run a commercial, well, you'd have to license somebody's song and pay a crap ton of royalties. Now you just say, look, I want a song that's kind of like that one, but different. Bang, you pay nobody.
Well, and by the way, just, you just kind of outed yourself, is that you're not really a Texan. And when you're messing around with country music is not about women, beer, and cattle, right? Or your dog. It's losing those things. So it's not getting them. It's country music is about losing your woman, losing your dog, and drinking beer. So
the old joke about what happens when you play a country song backwards. You get your dog back, you get your wife back. Yeah, exactly.
Exactly. So but yeah, no, what's important about that whole argument is the one thing that AI can't replace. It can't replace electricians, plumbers, pipe fitters, steam fitters. Those guys are safe. And
but they're going to have a much longer roadway.
Yeah. But eventually there's going to be robots that can do those jobs as well. So again, it's going to be very, the transformation is great. But, I remember when the internet first came around in 1990, and we were first starting to get into the internet, my dad was like, oh, that's, the computers are going to take over everybody's jobs. Well, he eventually lost his job to a computer, but other than that, the internet wasn't the job displacement monster that everybody thought it was going to be. It did displace a lot of jobs. Don't get me wrong. I mean, we no longer have receptionists. We no longer have a lot of jobs because of things we can do on the internet. But AI is a job displacement monster that I don't think a lot of people have actually fully grasped yet. And there's still this kind of beliefs like, oh yeah, well, there'll be other jobs to get that AI won't do. Well, name a job AI can't do right now.
Yeah.
And once you stick AI inside of a robot, tell me what job it can't do. Right. That's the scary part.
Right. And a robot that learns and keeps getting better very quickly. Right. So when it first rolls off the assembly line, maybe that first version can't do what you do as well, but by watching you and doing this a little bit and he learns from it, then very quickly the robot can do a lot of things that you can't do. So where I'm trying to go with this is a long discussion, but this was the key thing I just wanted to get in people's minds, which is I think just to be like really prescriptive, you got to either say, look, I'm late enough in my career that I think I can craft a path to get to the finish line before I'm supplanted by AI.
Yep.
Or you got to say, look, I got to figure out how to work with this thing. And to the NVIDIA CEO's comment, which is, oh, it's not going to be, AI is not going to replace the person. It's going to be the person who doesn't work with AI who loses their job to somebody else who knows how to work with AI, right? That's probably going to be the next wave. Probably after that, very quickly, it's going to be just AI replacing everybody. And we're already seeing lots of headlines about, thousands of people at Microsoft and whatnot, getting displaced by AI. But in a lot of cases, software teams that were that were tasked with building the AI were then fired because the AI could then do their job, right?
Exactly.
Yeah. So, but anyways, let's leave it at that. One thing I'd like to expound with you on when we have a little bit more time, Lance, because we're getting to the end of our second hour here, is, what is society like separate from the job loss and all that type of stuff? And look, there's a lot of things AI is going to do for us too. So there's going to be a lot of
a lot of benefits. Sure.
Yeah, a lot of light along with the shadow. But what's society like if you lose the incentive to create, right? Or the incentive to learn, right? Because there's a sense of like, why should I even learn to play the guitar like you did, Lance, if I can just have AI create an amazing song for me in 2 seconds, right? Why go through the months and months of learning the chords and getting frustrated and stuff like that, right? Or why learn in school if I've got my AI robot buddy that anything in the world I want, I could just ask him and he'll tell me, and he'll be smarter than I'll ever be.
Well, I do think, there is a thing though, and that's a good point, because there is a thing about scarcity. And let's say that we, and eventually we have movies that are all done by AI. Right now, Adam, you and I, you could write a script of questions, send them to me. I could write a script of all the answers. Then AI would create our avatars, and we could have the whole Thoughtful Money chat all done by AI.
Right. Or it could just watch our videos and even interpret what our answers are going to be. So you and I don't have to do anything. It just creates a virtual Lance and a virtual Adam. Yeah.
But then what that creates is that there is a human need for scarcity of things. And all of a sudden, there is a demand for actual art done by a person, because all the art's done by AI. But here's something really unique created by an individual, right? Or here's a song played by an individual that's not AI. And so right now, AI is very, gitchy and new and fascinating, and it's amazing what it can do. I do think there's a real risk to businesses. I agree with the comments. And this is why we're putting such a big effort in creating, integrating AI into our business. Because if we don't, like I told our CTO, I said, I need to lead the pack, not follow the pack. I don't want to be figuring out what to do down the road. I need to figure it out ahead of time and let other people follow us. And so that's his mission. And I think that's very important. If a business is, and particularly a business like mine, which is very easily supplantable by AI, you have to learn to integrate that in order to survive in this market. But I do think there eventually is going to be some great opportunities for individuals, because people will start to crave originality, and that human element at some point, I think, becomes a real thing that people want. It's because once everything's AI, people want originality, right?
Yeah. So look, this is why I want to have the longer discussion with you. I think it's an interesting, but honestly, really important topic for us, because like it or not, it's the future that we're hurtling into at a speed that most of us are unaware of. So let's earmark to do that again at some point soon here. One question I'll note, which we can delve into in that discussion, is, yeah, a lot of people are asking me, well, look, is AI going to supplant financial advisors, and are they going to be better at their job? And
No.
what exactly, and that's kind of where I'm going with this is, and we'll get into your real answer in a different video, but once it's a market of just AI trading bots, they all have the same information. They all presumably think the same way. So there will really not be a market in the way that we think about it, because there will just be an answer.
Yeah.
Right.
Yeah. Because what makes a market is we need, no offense. What I'm about to say, as I'm not trying to offend anybody, but we need stupid people in the market. We need people that sell high.
Well, not to be stupid. You need people to be wrong, right?
Exactly. Yeah. Well, but what I'm saying is we need people to make mistakes. That's what makes a market. And you're right. If AI is driving trading, then, you'll only be working on trying to arbitrage very small fractions of differences between trading, which is going to make a very stable market at that point.
Right. So, and it'll be interesting to see if AI really, can analyze, like if its track record in the long run is better. But look, that's a long discussion. We don't have time for it here. Let me just end on.
But I do think, just to wrap it up, I think that's, I do think AI is a huge threat to the financial advisory business.
Okay. Which is why you want to work with a good one, folks, while they're still around.
And thank God I'm old enough that I don't have much longer to deal with it. So.
Yeah. So to end on a positive note, so when I posted that song on X and explained how I created it, a bunch of people went off and started creating their own songs, and a not small number of people created thoughtful money songs. It was really cool. I want to give a shout out to two people in particular. There was a fellow named Dave Rainey. I hope I got that correct. He wrote kind of like a thoughtful money anthem. This would be kind of reminded me almost like kind of like a 70s sitcom lead-in, like a Welcome Back Kotter style of song. So maybe we create one for thoughtful money that becomes the lead-in going forward. But to lead us out today, I'm going to play a song that was created using AI by Robert Johnson. And this is called the Thoughtful Money Two-Step. Texas theme because of you, Lance. And the song goes back and forth between me with my California vibe and you with your Texas vibe. It really is kind of fun. So when we sign off here, folks, stay on for the next couple of minutes and I'll play that song for you. But Lance, as usual, another great week. Folks, if you think the best way to enjoy life before we're all supplanted by technology, AI, and robots is to continue watching Lance on this program week in and week out, let him know that by hitting the like button, then clicking on the subscribe button below. I'm going to make my pitch again. Please do click on the subscribe button if you haven't already. We're trying to get to 150,000 subscribers by the end of the month. One, because that's my birthday. I'd love to be able to celebrate that. But it does benefit you because if you do subscribe, you'll get alerted when we publish new videos in the future, so you won't miss any good videos. But third, and most importantly, it helps this channel. The YouTube algo gives this channel more love, the more subscribers it has, and the more aggressive subscriber growth it shows. And so that helps get important videos like this out to other like-minded investors like you, and really helps spread our mission of financial education. So please do click that subscribe button if you haven't already. And then lastly, if you'd like some help in navigating the road ahead here, and as Lance has said, things are pretty stretched. Maybe you want some help in revisiting your financial goals for the year. Maybe you want some help in putting some hedges on your portfolio. Maybe you want some hedges just about making yourself a little bit less vulnerable to a potential 6% pullback, if that's indeed what we end up having. I highly recommend most people watching this video get that help from a good professional financial advisor, one that takes into account everything that Lance and I have talked about here. If you've got a good one who's doing that for you and taking good care of you, great. Don't mess with success. But if you don't, or you'd like a second opinion from one, maybe even as Lance and his team there at RIA, including all their new AI experts they've got on there as well, then you can schedule a free consultation with these firms by filling out the short form at thoughtfulmoney.com. Again, these are the firms you see with me on this channel week in and week out. And as soon as you fill out the form, the firms will be in touch with you. Lance, my friend, another great week. I'll let you have the last word as usual.
No, that's it. Got a great time, and we'll see what happens next week.
All right. Everybody, don't forget to stick around and listen to the Thoughtful Money Two-Step. But until we get there, thanks so much for watching.
Out in San Francisco, where the tech winds blow, Adam Taggart's got that Stanford glow. Bay Area dreams with a VC's flair, sipping oat milk lattes in the coastal air. He's wired to the markets with a mindful take, charting the future for the world's own sake. Down in Houston, where the oil rigs hum, Lance Roberts rides with a conservative drum. Chemicals and crude, it's an industrial beat. Boots on the ground, he's got that Texas heat. He's crunching the numbers with a skeptic's eye, calling out the noise neath the Lone Star sky. It's the Thoughtful Money Two-Step. Watch him take the stage. Adam's cool and coastal, Lance is fire and sage. From the bay to the bayou, they're breaking it down, talking stocks and bonds with the truth profound. Every week they rant, yeah, they let it fly. Adam and Lance with their eyes on the sky. Adam's got that tech bro vibe, all sleek and lean, Stanford polish with a silicone sheen.